Hey, good morning, everyone. Marty Mazur here, 4th of November, 2022, Friday, with your end of week market snapshot. I'll circle back later tonight or over the weekend with your weekly economic update. We're going to start this week with the weekly chart. That's the one you have on your screen. And as you can see here, we are testing this downtrend line, looking for it to provide some support. So this is your weekly candle, right? So that's this week. You can see the 20-week moving average provided all the resistance the market needed right here. And of course, that's right at that 3,900. And you remember I said, I think last video and the one before that, specifically the one before, because we were moving up toward 3,900, that would be kind of a brick wall for the market, which it's proving to be so far. Dipping back below, as you can see the shadow here of the candle, dip below the trend line here, but we're resting right on it as we speak. The 200-week moving average is moving in the right direction. So again, this is a constructive look, breaking out of a falling wedge with bullish divergences, losing the buy signal here with the recent sell-off on the Fed meeting, but look like we're trying here to capture that back, if you will. As for the daily chart, so looking at it on this timeline, definitely some damage was done with the Fed meeting. So we had some nice momentum. We had some good look here, and the 20-week moving average still do. But we're beginning to roll over here. You can see it. This is the histogram is the most sensitive in terms of what to expect here on the MACD, or what's developing under the surface. And then, of course, on the Fed meeting, and actually on Powell's press conference, we saw the market come crashing back down below the 50-day moving average. And now that's providing some resistance. And again, remember, I'll say it one more time, there's that brick wall at 3,900 that we highly anticipated. So this is as much technical, perhaps, as it is fundamental. Now, this morning, you may have noticed already, we are having a whopping rally. As I speak, the S&P is up 1.75%. Foreign equities are screaming higher, particularly for Europe. Our European ETF is up 5.5% this morning. And the commodities complex is screaming higher. Our metals miners ETF, which is a core position, is up 8.1% this morning. And our one rare earth miner is up 11.5% this morning. And they announced earnings yesterday, which beat expectations as well. Silver's up almost 6%. Our materials ETF is up 4%. Our emerging markets ETF is up 3.8%. Brazil is up 3.8%. So quite the morning so far for our core portfolio, obviously. And we are leveraged to, obviously, global macro. We have a real international commodity theme. So a lower dollar screams to what we see going forward over the next few years. Anyway, but from a technical perspective, market has to come back through this 38% retracement level, back through the 50-day moving average. We had a strong jobs number this morning. It was notably better than what was anticipated. Average hourly earnings were a little better than anticipated. What was worse, I'll use air quotes because worse is good for stocks right here, one would think based on how it's trading, was the unemployment rate actually ticked up 20 basis points. I will say that the very recent anecdotal data leading into today's number, which wasn't going to be reflected in today's number, was actually negative for the jobs market. The Institute for Supply Management Services survey came out this week, and it actually showed a contraction in the labor component. Manufacturing actually improved a little bit month over month in its labor component, but it was at 50, which is just a dividing line between expansion and contraction. The JOLTS job openings number came in with actually 1 million more, but there's a lag there. That was all the way back for September. There's a month lag there. So it could be that the market is focusing on the anecdotal data with regard to jobs, and it would make sense. And I think it's clear or obvious that we are going to see a slowdown in the jobs picture in the coming months. The other thing too is that this news or this rumor that China's about to unlock, so to speak, or work on ending the COVID draconian lockdowns that they keep doing, and they're doing them as we speak, but the news is that they're working on a strategy for getting out of that. And I've said this for months now, folks, and you'll recall that that would be hugely bullish for global equities and global commodity markets. And we are seeing that today as well. So whether this is a knee-jerk reaction to a jobs report that was better, but not, not at the extreme amid weakening under the surface conditions that might stay the Fed's hand a bit as we get into next year. Is it the China situation and what that ultimately means for the global economy, somewhat averting something terrible from a global recessionary perspective, if we look at it that way, and therefore corporate earnings actually doing better than many of the pundits are saying they're going to do going forward? Maybe more the latter, right, than the former, or maybe a combination of all of it. And then don't forget, this is a huge period right here for seasonality. We made that case in late September, and that really played out in October. Said on the last video, I still see that, but not as strongly as we were in September. Some of that oomph has been realized, and of course, because of that, we don't have the the contrarian indicators that said it we can go screaming higher. But it's like, okay, the world's not going to end on that jobs number. The Fed's not going to push interest rates through the roof on that jobs number. And I've shared with you here our underlying thesis as to why the Fed can't push interest rates through the roof. But that notwithstanding, under the surface, the market has been looking for an excuse to rally. So you have strong seasonality. You had the big dip on Powell's press conference. You had a jobs report that wasn't just crazy to the upside amid anecdotal data coming in day to day that says jobs are going to weaken or the jobs picture is going to weaken. But, you still have to be guarded here. You could very well see the Fed come out and try to quash this, although I don't think to the extent they were doing it earlier this year, a few months ago. There's some systemic risk under the surface that definitely has their attention. So let's just look quickly at the hourly, and I'll let you get on with your morning. As I said on Wednesday, this was a very bearish look, very bearish, right? We had a rising wedge and very bearish divergences. And sure enough, we got that sell-off. So the setup going into the Fed meeting, we had that conversation right in here. Technically, it was pretty ugly anyway. And then we did get a bit of a rally on the announcement. I wrote about that yesterday, but then when Powell, he effectively, said some things that the market got worried about. The written blog, I think I spent enough time on that. But then again, here's what we have today. We have this big gap up, pushing right now up against this resistance line right here. As you can see, it was pretty good resistance back here in early October. Then it was support, busted through that. It would make perfect sense that we run into some resistance here, roughly 3,800 on the S&P, picking up some momentum. You can see the RSI coming off of here. Wouldn't surprise me if we break through that again. And if you do, there's not much stopping it between here and 3,900. Again, seasonal trends are very bullish right here. And right now, as I speak, there's a big fear of missing out that's being expressed in this morning's market. And right now, we're about an hour and a half after the open. So, of course, anything can happen intraday. This has been a most volatile market, to put it mildly. And frankly, I don't think that's going to change anytime soon. Folks, thank you as always for watching and listening. Again, you'll hear from me one more time between now and Monday. And hope you have a good rest of the day and hope you have a great weekend. Take care. Bye-bye.